Today we're going to take a deep dive into wave trading, and I've prepared a video where we will cover everything you need to know when it comes to wave trading. We're also going to cover Elliott wave, and I've prepared trading strategies that use the concepts of wave trading and how to trade waves in a much better way. To understand waves better, it is helpful to start looking at trends. And when we look at a trend, you will often see that it will unfold in this wave-like rhythm. It is going back and forth, up and down. And we call those moves trend waves. And by understanding those trend waves, we can actually gain a lot of understanding about the markets. And when we talk about waves, we distinguish between impulsive and corrective waves. So generally, we have to identify the bigger picture trend. In this case, it is going down. And at the end of the video, I have some tips for you on how to actually identify the big picture trend. But in this case, we're looking at a downtrend. And in a downtrend, we call those waves that go with the trend into the big picture direction impulsive waves, and the trend waves that go against the big picture trend, we call them corrective waves. And by analyzing those waves and how they shape up, we can actually learn a lot. So when we look at the differences between the corrective waves in this example, what can we actually learn? So here we have a flat correction wave. The market just went sideways after a bearish market move. And this means that the buyers are obviously not very strong. Also, there's probably not a lot of profit taking going on, because if there was profit taking of the sellers, it would also contribute to more bullishness. So in this case, when you can see a flat correction wave in a downtrend, it shows you that the ongoing trend is likely not being broken and a continuation is quite likely. When we follow this trend now, you can see the next corrective wave is pointing upwards slightly. Still, the angle is very flat, it is not very strongly going up, and it is a little bit stronger on the bullish side than what we have seen here, but it's overall still very weak. And compare that to what we are seeing here on the third corrective wave. We have a much stronger rising angle. We are also coming much closer to the previous high point of the previous impulsive wave. So here we have way more bullishness, which can be a sign of more profit taking. And it does make more sense here to see profit taking, because people who have been selling all the way through this downtrend, when the price gets lower, they are sitting on more profits and more profit taking is likely. Also, people who want to buy whatever market we are looking at are now more interested in buying this market because the price has fallen quite a bit. And of course, if you want to buy whatever it may be, it makes sense to wait for a low price. And when the price has fallen, more people are ready to buy for a lower price. We can also look at the impulsive waves to get a much better understanding. First of all, a very steep and strong impulsive wave shows that the trend is intact and it is likely to continue. Shorter impulsive waves show less strength, and especially when shorter impulsive waves come up later in a trend, it shows that not too many people are probably interested in continuing this big picture trend anymore. A lot of people who have been shorting probably have shorted earlier, and who is getting in short now is probably way too late. And that is often a picture that you will see as a trend progresses. The impulsive waves get shorter, not as steep, and the corrective waves increase in size and also in strength. We are soon getting into Elliott waves, but first of all, let me provide you with a few tips on actually understanding waves and the big picture trend, because when we look at a chart, it is often not clear what is the big picture trend and what are corrective waves and what are impulsive waves. And one way to improve your wave understanding is start using a 50 period SMA. I use the SMA here, 50 period, and you can use it pretty much on whatever time frame you are using Elliott waves or waves in general. And what you will often see is that when the market starts dipping below the moving average, like in this case, if it comes from above the moving average and it starts trading below it, that's then where the big picture trend changes. Another tip could be, if you trade, for example, the 30-minute chart, use the moving average from your 2-hour, 4-hour, or even from your daily chart to get the higher time frame trend. But what I have seen is really helpful is use the 50 SMA, and that is how I try to determine the big picture trend direction. You can also add a shorter moving average. Now we have here in red the 20 SMA, and the 20 SMA can help you understand short-term, especially corrective waves. And what you often see is that in a corrective wave, the market moves back into a short-term moving average. So here the 50 SMA shows us that we are in a big picture downtrend, and the short-term 20 SMA shows us where corrective waves are taking place. So the impulsive waves are moving away from the moving average, and then the corrective waves are moving back into the short-term moving average. And that is what I found a really helpful tip. And then, as we will see later when we come to actual wave trading strategies, what we can do is then look for trading opportunities at either the short-term moving average or the long-term moving average. And we're going to determine the long-term trend direction and then look for specific trading situations and signals, as I will explain in a moment, to improve our trading strategies. Now let's take a look at the most important concepts when it comes to Elliott waves. And we're just going to take a brief look into the most important basic principles of Elliott waves theory. And if you are interested in a more advanced video, let me know in the comments below. So the key message of Elliott wave theory is that trends play out in 5 waves on average. So what this means, we're coming from a range, we are trading sideways, there's no trend going on. And then as a trend unfolds, you will often see that we have 5 waves into a trend direction. And then Elliott wave theory suggests that on average, which is the keyword here, as I will show you in a moment, the trend will end. So what we have impulsive wave 1, corrective wave 2, impulsive wave 3, corrective wave 4, impulsive wave 5, and then Elliott wave theory suggests that on average the trend is over and a continuation is not very likely. However, the big problem that many Elliott wave traders have is that they take it too literal, and I think the key message here is really on average. And trends can obviously last also sometimes for only 3 waves, but they can go on for 7, for 9, for 11, or for more waves. And I think that is where a lot of traders struggle with Elliott wave, because they are not discretionary enough. And there are situations where trends can go on for a long time. However, I think that there's also a lot of value in the underlying message of what Elliott wave suggests. And in my trading, I don't use Elliott wave theory one-to-one, but I have taken some ideas from it. The most important being is that as a trend matures, as we are getting into wave 5, wave 7, wave 9, I am not as likely to look for continuation trades, because the longer a trend goes on, the lower the likelihood that we will see a continuation. So I would suggest that as you see a trend matures, as we're getting into the later waves, don't look for trend continuations as aggressively anymore, and get ready to, if you are in a trade, take exit or even start looking for a reversal. On the other hand, if you see that you're just getting started and you are maybe just coming out of wave 2 and continuing in wave 3, that's really where you can be a little bit more aggressive and look for continuations, because you are early on in a trend, and early on in a trend, it is more likely that you are going to see a continuation. So those are really my main takeaways, and that is how I found that Elliott wave theory, or at least some concepts of Elliott wave theory, can be applied in a very good way. Now let's put Elliott waves to the test, and I prepared 4 tips and strategies on how to apply the concepts of wave theory. So tip 1, we want to trade corrections, and this allows us to trade into the bigger picture trend direction. So first of all, you want to wait for the market to start a new trend. A new trend is started when the market goes from trading beneath the 50 SMA to trading above it. That's the first clue, and that's where wave 1 starts. Then you can wait for the market to move back into the moving average, and that is then typically a good signal that you are looking at a correction. Furthermore, what often happens is that as we are having a correction, patterns are often building. They can be sideways patterns, they can be flags, and in this case we have a very objectively identifiable pattern, which means that the pattern is very obvious, it's very clear. We have a resistance level here, and we can use that for our advantage and trade a breakout. So a breakout will then typically start our new impulsive wave number 3. Wave 1 is here, wave 2 is the correction, wave 3 is going to be the next continuation. So wave 3 is ideal because we are early on in a trend and it is likely to see a continuation, and that is what happens afterwards. Of course, there can be times where the market keeps going higher and gives you more correction wave opportunities. As I've just said a few minutes ago, as a trend progresses, it is not as likely to see more continuations. However, there are instances, obviously, when trends last for a long time, and sometimes you will be able to trade multiple correction waves into a moving average. Next tip, look for divergences as a trend matures. So we are trading here below the moving average. We are starting here a new trend. And then you can see we have wave 1, wave 2, wave 3, wave 4, wave 5, wave 6, wave 7. And then at wave 7, we are starting to see a divergence. And we're using here the 14 period RSI, and the RSI is a momentum indicator. And what you will often see early on in a trend, when we look here at wave 1, when we look at wave 3, when we look at wave 5, you will often see that the RSI is confirming the strength. A new trend often is quite strong, and that is also reflected in the RSI. The RSI is going up and confirming that you're looking at a very strong trend. However, as the trend matures and we are moving into wave 5, 7, 9, often, as I've said, the trend will not be as strong. And we can see that the market is not able to push higher that strongly anymore. We are barely able to make a higher high. And the RSI confirms that with a divergence. And I would recommend look for divergences only in mature trends, because that is where it is more likely to see some type of reversal and also to see the trend fade. And then you can see afterwards the trend really ended. We dipped below the moving average and we're starting a new trend from a big picture uptrend to now potentially a big picture downtrend. And we are now back in wave 1. Tip number 3, we can use our Fibonacci tools to look for completed fibs. If a Fibonacci sequence is completed, we are often looking at the end of a trend. So what we want to do is early on in a trend, we want to identify wave 1 and we draw our Fibonacci from the starting point to the end point of wave 1. And that often gives us then a very nice Fibonacci sequence. So from here to here and then back to the 76.4, we have a Fibonacci retracement. This is our corrective wave. The next impulsive wave leads us to 127. When the price reaches the 161 or the 200 Fibonacci level, that's usually where we are talking about a completed Fibonacci. Also, in which wave are we? Wave 1 happens here. Wave 2 is the corrective wave. Wave 3 is here. Wave 4 is the corrective wave. And wave 5 is now here our completed Fibonacci. So as the Fibonacci has been completed and we have also completed the Elliott wave count, it is not super likely that we're going to see a continuation. And when we just follow the price chart here a little bit further, we can actually see that the market did roll over, and we can do the same as well. Whereas this is our low point from here, we can now wait for the new wave 1 into the uptrend. So wave 1 in an uptrend happened here, and we draw our Fibonacci from the beginning to the end point of wave 1. We have a good corrective wave back into 61.8 on the retracement. Then we have wave 3, wave 4 here, and wave 5 is somewhere happening between 161 and 200. That is where you are talking about a complete fib. And then it is not likely to see continuation, and you will see afterwards the market actually never continued to trend higher and fell lower. So completed fib, especially if it happens in the right chart context, in the right wave context, somewhere around wave 5 to 7, that's really where the likelihood of seeing a continuation is very, very low. With tip number 4, we are looking at exhausted pip ranges. And we are taking here the example of Forex, but this applies to any other market. So when we look at, for example, the Euro-US dollar pair, and we look at how much did the Euro-US dollar per day move for the last 5, 10, 20 days. And then we may get something like 124 pips per day. That's what you can expect for the Euro-US dollar to move. And this is a very, very important piece of information, because if we know that the market has on average moved 124 pips in a day, and if we then are trading the Euro-US dollar on a day and we see that a trend has already exceeded 124 pips on a given day, it shows us that it's not super likely to see a continuation, because on average, after 124 pips, the market has actually stopped moving. And to make this work, we can, for example, use the ATR on our charts, and the ATR will then show you how is the volatility, how much has the market moved. You could apply a moving average to your ATR, and then in this case, it probably will show you that the trend that has been going here is already exceeding the ATR, and you are looking at a very mature trend that has exceeded how much the price moved on average. However, With Pattern Alpha, we actually created a tool and we call it a exhaustion zone. This is the yellow zone that you will see here on this chart. There's also a link to the indicator if you want to buy it. And what the exhaustion zone does is it pretty much just draws the ATR zone on your chart. And as you can see, this is where the ATR and the exhaustion zone starts for this market. And as the trend progresses, it is then moving into the ATR zone, which shows you that at this point, on average, in the past, the market has stopped trending and a continuation is not super likely anymore. So if you're in a long trade, you could, for example, use the exhaustion zone to time your targets. When the market reaches the exhaustion zone, you really want to think about taking profits because it's not super likely to see more moves here and you can avoid giving back profits. Also, if you're a reversal trader, you could start looking for reversals after the market has exhausted the pip range, especially if you're also looking at a trend in wave 5 or wave 7, and then other things are coming together. You could draw a trend line here for a breakout, for example, and then you can see as the market moves away from the exhaustion zone, dips back below the moving average, we're starting wave 1, corrective wave 2, and then impulsive wave 3, and so on and so forth. So looking at the ATR and how much has a market moved on a given day, the ATR or the exhaustion zone are very, very helpful tools as well. And that's it for my deep dive into wave trading. I hope you enjoyed it. I hope you learned something. If you did, leave a comment below the video. Also, don't forget to subscribe to the channel, and I look forward to hearing from you.